Hello, my name is Sian Anderson. I'm the head of the School of Finance and Accounting at Varsity College. I'm also the subject head for Financial Accounting 3, and I'm going to be doing some integrated revision questions with you to prepare you properly for your assessment, your final assessments. The question I'm doing is called Aloha Limited. Aloha is a manufacturer, and the question incorporates IAS 12 income taxes, IAS 16 property, plant and equipment, IAS 40 investment property, and IFRS 16 leases. The required of the question is split between calculations and disclosure, so you're going to spend quite a bit of time doing the calculation part of it and then using your calculations that you did in the early part of the question to answer the disclosure requirements in the second part of the question. Right, we're going to get started with the reading of the question. Now, reading the question is very, very important. In fact, you need to spend as much time as possible on the reading of the question, because if you unpack the question properly when you're reading it, it's going to make doing the answer so much easier. So if we look at the required of this question, as we've said already, Aloha Limited is manufacturer. You're then presented with a trial balance. Now, when you're given a trial balance, it's very easy for you to use and easy to see. So it's nice to be presented with a trial balance. Skim read the trial balance and then move on to the additional info. But before I do that, I'm going to talk about the required, because it is important to just unpack the required first before you actually answer the question. Because if you do that, it'll give some context to the question when you actually begin to read the rest of the info. So if you look at the required of this question, you'll see it's split into three parts. The first two parts focus primarily on calculations. Format's not that important, okay? You just need to get stuck into all the calculations, and there are a lot of them, especially in part 2 of the question. The third part of the question focuses on disclosure. Now, this is where you're going to earn quite a lot of the marks, but a lot of the calculations for this part of the question you've actually already done in the first part of the question. So even though this looks like quite a lot of work, it's not going to be, because you've done all the workings already. So the disclosure is to do the income tax note, the deferred tax note, the PP&E note, and the lease note. Okay, so it's quite varied disclosure. But as I said already, the calculations have all been done, and therefore you should be quite quick when you get onto this part of the question. Right, let's go back to the trial balance. You're given a trial balance, and it's a very easily presented question. The trial balance is provisional, and you can pick that up very easily from dates that are given in the question. So if we look at the background to the question, Aloha is a large manufacturer. Pay attention to the fact that they're a manufacturer, because if you're doing tax, that's got a big impact. They make tractors used in the agricultural sector. They're sold for cash. They're listed on the JSE, and they have a 30 June year end. And you can see that the information presented is for 30 June 2019. But when you look in the trial balance, you can see that a lot of the dates are 30 June 2018. So obviously you're given information which isn't necessarily at year end. So for example, retained earnings, 30 June 2018, deferred tax, and then the accumulated depreciation. So all of those are at the end of the previous year. So that's telling you that this trial balance that's been presented is not final, it's provisional. And you're going to be calculating things like depreciation, taxation, deferred tax, etc. The other clue in the question as well is if you scroll down in the trial balance, you can see that the income statement information is given separately. Now that's also always a clue that, for example, retained earnings is at the beginning of the year. Because if the retained earnings was at the end of the year, you couldn't see revenue, cost of sales, etc., because those would already be processed into retained earnings. So again, the minute income statement information is presented separately, that's telling you that the retained earnings figure that's been given is at the beginning of the year. With regard to the trial balance, this trial balance is a fairly standard trial balance, so you don't need to spend hours and hours poring over it. Just skim read it, picking up any anomalies, which when you look at the videos, you'll see that I've unpacked the anomalies in the trial balance quite quickly. There's then quite a lot of additional information. As you read the additional information, scribble on your question paper, highlight in a different color, underline, flag, whatever. Make notes as you go along. You don't want to be reading the question and then going back and reading it a second time once you start answering the question. Rather now, when you're reading the question, underline, highlight, flag, etc. as you go along, because this will speed up the process later when you get into the question. So you'll see when I'm reading the question, I'm highlighting, I'm pausing, I'm unpacking. I want you to do that when you read the question so that you don't waste time later on when you're trying to do the calculations. Process everything you need whilst reading the question. And then later on, once you start answering the question, you don't have to go back and think about it. You've made notes so you know where the challenges are. Okay, the required is split into 3 parts. Okay, the first and second part are pure calculations. Calculate PBT, calculate income tax expense. Okay, you're just going to quite simply do them. Okay, so when it gets around to doing the actual answer, we're just going to jump straight in and do those 2 parts of the question. The third part is your disclosure. Now that's the part which is a little bit more tricky because you've got to think about exactly what is required in that disclosure, and your presentation and format is going to be important. But the upside when you get down to part 3 of the question is that part 1 and part 2 will already give you a lot of the figures that you actually need for part 3. So if we just look at part 3, it's requiring disclosure of the income tax note, the DT note, PP&E, and leases. So have that in mind when reading the question that you're doing disclosure, and bearing in mind that the disclosure, for example, PP&E and the lease note, both are movement analysis. So you need opening balances, movement, and then closing balances. If we then just look at part 1 and 2, part 1 is typical, calculate PBT, straightforward. And then part 2, income tax expense. Now, part 2 of this question probably would have been for about 20-25 marks. Because remember, even though you're calculating income tax expense, in order to do income tax expense, you need to do the deferred tax calculation. So part 2 will be significant marks because it incorporates the DT calculation as well, in order to get your movement to pop back into the PBT, into the income tax calculation. Okay, so we've unpacked the required. Let's go back and let's look at the trial balance. Now, when you look at the trial balance, you don't need to wade through every single solitary line. You just need to process what you're presented with and unpack anything which is a little bit unusual. So if we start off at the top of the trial balance, it's fairly typical. Share capital, retained earnings, DT, nothing exciting there. Down to PP&E, bank balances, inventory, etc. And the only item there that I want to just talk about a little bit more is provisional tax payments. So process, what is that? The provisional tax payments will be payments made in the current year towards the current year tax liability. So you will need to unpack that a little bit further when we get to additional information number 7. Okay, but it's an unusual item. You need to process it. And then you can also see that the trial balance splits for you the current portion of long-term liabilities from the non-current portion of long-term liabilities, because remember, you're going to need that for your disclosure. And then the bottom of the trial balance is fairly usual income statement information, but observe that there is no other income. So if there is any other income, it has probably been deducted from other operating expenses. You need to take cognizance of that as well. Right, let's start looking now at the additional information. Note number 1, bit of a moot point this one, because you knew that already from the given trial balance. Okay, so the question's clarified for you that depreciation and tax has not yet been processed, but you picked that up from the dates that were given already. Note number 2, long-term borrowings. Okay, consists of the loan, a loan, and the lease liability. Now again, just pause and think for a minute. The question's asking you for tax and lease disclosure. So this note and the lease side of it is going to have significant impact on answering the question. Okay, the lease accounting requirements different to the tax requirements, and then there is all the disclosure. So let's have a look at the lease side of it. The lease liabilities in respect of motor vehicles, refer note 5, we're going to look at that just now, was entered into on 1 July 2017. Now again, process the date. 1 July 2017 is 2 years ago. Our year end is 30 June 2019. So we're in the second year of the lease, not the first year. The total amount of interest payable on the lease liability was 593,520. That's generous that that amount has been given to you, because normally you would have to work that out. It isn't difficult to work out. If you look at the amortization table that's given, all the interest figures are there. So you could actually just add them up. But there's no need to in this question because they've been generous and given you the amounts. The accountant of Aloha provided the following amort table, which you may assume to be correct. So again, that's a bonus. The amort table has been given to you and it's correct. So all you need to do is unpack the table and think about what you're going to be doing with all the figures. The first thing that you need to notice is the first installment is 1 July 2017. Now let's unpack that. The lease was entered into on 1 July 2017 and the first payment is made on the same date. Therefore, that means that these payments are in advance. That entire payment is therefore capital, and you can see that it's been popped under the capital column on the amort table. Okay, so there's no interest there, it's all capital. Now, when payments are in arrears in a lease, you've just got to think a little bit differently. If it's in advance, it's easy. The payment would be at the end of the year, and if it aligns with year end, it's straightforward. But in advance just throws a little bit of a different perspective on it. So let's just unpack it. If we just stick with the dates as they're presented, we entered into the lease on 1 July, and the first year end was 30 June 2018. Now let's unpack that. When we get to that year end, no payment has been made. Okay, so this lease has been in existence for an entire year, and yet by the first year end, no payment has been made. In fact, the first payment is going to be made the very next day. But what you need to understand is that payment that is going to be made on 1 July 2018, in fact, includes interest for the previous period. So when we got to the year end 30 June 2018, we would have needed to accrue the interest. And you can see clearly the amortization table tells you that. However, we're in the next year. So let's go down to year end 30 June 2019. You can see there clearly interest of 174,182 has been accrued. So that's going to be our interest expense in P&L. That interest will then be paid the first day of the new financial year as part of the installment, which is made on 1 July 2019. Okay, let's unpack it a little bit further. Again, let's think of what we're being asked to do in this question. So we need to disclose the lease. What is the balance on the lease at the end of June 2019? Again, just use your amort table. So at the end of June 2019, 114,1862 is the amount owing on this lease. The only thing you need to remember is that 114,1862 needs to be split between the portion that's payable next year, which is next year's installment, including the accrual of interest for the current year, and then the rest of it is non-current. So the easiest way to do your disclosure split is to just work out next year's figure. Balancing figure is then the non-current disclosure. The other thing to just note in this lease information is it's a lease for motor vehicles. Now the question clearly tells you VAT of 15% is included. This question's testing your VAT knowledge as well. Remember, VAT on motor vehicles may not be claimed back for VAT purposes. In other words, the cost of these motor vehicles will be VAT inclusive. And so you can see that the cash price was 1,596. In other words, that's going to be the cost of the motor vehicles because we can't claim back the VAT. So I'm just going to pop down now to note number 5, just to clarify a bit of information about the motor vehicles. So ALOA elected to disclose the right of use assets separately on the face of the statement of financial position. So let's just pause and unpack that for a minute. IFRS 16 gives you a choice. You can either disclose the right of use asset as part of PP&E, or you can disclose it as part of the lease note. Doesn't matter where you disclose it. This question is telling you that they are choosing to disclose it separately on the face of the statement of financial position. In other words, it's not going to be part of the PP&E note. In other words, you're going to disclose the right of use asset as part of the lease note, and it then will be presented separately under non-current assets as right of use assets. Depreciation is 20% per annum, straight line method, and the question's now telling you that the VAT may not be claimed. Don't always expect that, okay? Remember, part of what you need to learn to do is to integrate knowledge from all subjects into a FINAC question, for example. So this question could well have not told you that the VAT may not be claimed back. You're expected to know that as a third-year student, having studied VAT as part of your taxation syllabus. Right, let's go back up to information number 3. Right, let's look at point number 3, plant and machinery. The plant and machinery was acquired on 1 July 2016 for 3,125,000. As you see the date, process it because it's going to impact on possibly your wear and tear and your depreciation. Plant and machinery is depreciated on a straight line basis over the total estimated useful life of 10 years, and SARS allows the 12C manufacturing machinery allowance. So what's important about that is we already know that they're a manufacturer. You're not told what the Section 12C allowance is, so you're going to have to look it up. That's why you've got your books with you. You look it up in your tax legislation. What you need to bear in mind is that the 12C allowance is not a portion for part of a year, although in this instance it doesn't matter because the machinery was acquired at the beginning of the financial year. So all you need to do is work out and see where are we in terms of the allowance. The machinery was acquired on 1 July 2016. So in terms of 12C, you would have been granted an allowance of 40% for the 2017 financial year, 20% for the 2018 financial year, and 20% for the 2019 financial year. So at the end of the current year, we will have written off 80% of the cost of this machinery for tax purposes. From a depreciation point of view, we will have done 4 years worth of depreciation by the end of the current year. Right, land and buildings. At 30 June 2018, in other words, your opening balance consisted of the following. So we've got a factory building and land. Now again, process factory building. What does that mean from a tax perspective? It means SARS is going to give us the tax allowance on the manufacturing building, not apportioned for part of a year. So let's have a look at it. You're given the cost, you're given accumulated depreciation, and you're given the carrying amount. So those figures you can safely use as your opening balances for your PP&E note because you're given them. So you've got land and the factory building opening balances already. The factory was constructed at a cost of 1,240. We can see that in the little table. It was available for use on 31 December 2017. So the first year that we would have claimed an allowance on this building would have been the 2018 financial year, which was last year, and then now 2019 we can claim the allowance as well. Depreciation 5% per annum, straight line method, provided on all buildings. SARS allows the 5% annual allowance in terms of Section 13(1)(b). Now let's just process this as well. For plant and machinery, you were just told 12C. You had to figure out where we were from a 12C perspective. For the land and buildings, you've been told it's 5%. But again, that may not be always given. So you would have to look up in your tax legislation book, 13.1b, seen that it was 5%. But let's be honest, by now you should know that those manufacturing buildings are 5%. Most important thing to remember, not apportioned for part of a year. So this building was ready for use on 31 December 2017, which was halfway through the 2018 financial year. But we don't apportion it because remember the SARS statutory allowances are not apportioned for periods of less than a year. So even if we'd acquired the building on the last day of the financial year, we could have still claimed the full 5%. So depreciation last year was apportioned for 6 months, but the wear and tear wouldn't have been. Current year's a full year, so 5%. No problem. Right, then let's read further. On 31 December 2018, halfway through the current year, the company moved its manufacturing operations to leased premises as the building did not meet their requirements. It was decided to keep the building and lease it out. So let's unpack that. It's owner-occupied buildings until 31 December. It's PP&E. On 31 December, it will then be transferred to investment property because it's now being rented out. And that's going to have a whole bunch of implications that go hand in hand with it. But let's read further before we process those. Tenants occupied the building from 1 Jan. The market value of the property was as follows, and they've given it to you on 2 dates. The date that it becomes IP, 31 December 2018, and financial year end, 30 June 2019. Aloha uses the fair value model for measuring IP and the cost model for measuring OOP. Rent received and direct operating expenses amounted to 150 and 60 respectively for Jan 2019 to June 2019, and it's included in other operating expenses. Now that information there is just for your PBT note disclosure. Remember, if you have investment property, any expenses incurred must be disclosed, either as expenses for property rented out or as expenses for property not rented out. In this instance, the property was rented out, so we'll disclose it as direct operating expenses for IP rented out. The accounting entries relating to the revaluations and fair value adjustments on landed buildings for the year ended 30 June 2019 must still be processed. Okay, so they haven't done any of the entries for you. So let's unpack it. Now we've clarified that PP&E buildings are accounted for using the cost model. Investment property is using the fair value model. But remember, in terms of IS 40, it doesn't matter what model you are using in terms of PP&E. The property must be revalued prior to transfer. So even though we're using the cost model for PP&E purposes, if property is transferred out of PP&E into IP, you have to revalue it before you transfer it, and it's done on the date of transfer. So what we're going to do with this property is we're going to depreciate the building as per usual for the first 6 months of the year as PP&E. Then, whatever the carrying value is on that date, that amount will be revalued to the fair value that's given of 1.3 million. And that difference is a revaluation surplus that will go to OCI as per usual. Similarly, the land will also be revalued on the same date, but obviously there's no depreciation or anything like that on the land. So it has to be revalued before transferring it. Then the figures of 200 for the land and 1.3 million for the building will be transferred into IP. So that becomes the cost for IP purposes, It's now IP for the rest of the year. So what do we have to do at year end? At year end, we have to fair value adjust it, and that fair value adjustment is going to go to P&L. And that is important because remember, the first part of the question asked you to calculate PBT. So we've got a reval for the first 6 months, and we've got a fair value adjustment for the remaining 6 months. The reval goes to OCI, does not affect PBT. The fair value adjustment goes to P&L, does affect PBT. And then of course remember the tax implications as well. Okay, so the land and building's a little bit tricky. You're doing a PP&E note, you're not doing the IP note. But in the PP&E note, you're going to have the property at the beginning of the year, you're going to depreciate it, revalue it, and then transfer it out to IP. So end of the year, the balances will be zero under PP&E because it's going to be disclosed at fair value under IP. Right, let's move on to number 5. Motor vehicles, we've already looked at. So straight down to number 6. Trade payables. Includes provisions in respect of expenses of 350, last year's figure 285. These provisions will be allowed as a tax deduction where the amounts are paid in cash. Now, number 6 doesn't tell you what the provision is for, what expenses. It doesn't matter. The fact that SARS won't allow the provision as an expense until it's paid means you've automatically got a temporary difference. So from a tax point of view, we'll have the carrying value of the provision, but there will be no tax base because SARS is going to only allow it as a deduction when it's paid. It's as simple as that. You don't need to worry anymore about point number 6. Point number 7, the provisional tax payments. So remember, provisional tax payments is payments made during the year to SARS in respect of any current tax that's going to be owing. Now you can see here that there's a few anomalies. Firstly, there's an under provision for last year. Now one of the mistakes that students often make is when they see the under provision, if they are doing comparatives, they automatically want to put it under the comparatives. But you can't do that. Okay, if you under provided for tax last year, it becomes part of this year's expense. But we highlight it specifically as an under provision. So it's still part of this year's tax, but as a separate item under provision for the previous year of assessment. And then there's 2 other amounts, penalties and interest, because we paid our provisional tax payments late. Simple, both of these, they're expenses. So firstly, they shouldn't be sitting under provisional tax payments. They should have been expensed to P&L. So we will have to add them to other expenses. And secondly, remember, SARS will not give you a tax deduction for this, and therefore there will be exempt differences in your current tax calculation. Straightforward, you've done plenty of those before, so they shouldn't cause you any complications. Number 8, also easy. Other operating expenses include donations of $4,000, not tax deductible, as simple as an exempt difference in your tax calculation. And lastly, number 9, the usual information. Tax rate 28%, CGT inclusion rate 80%. Then, a little bit of a curved ball. On 30 June 2018, the assessed loss for tax purposes amounted to $150. So that's telling you this company had an unused tax loss last year, 150K. It's probable that future taxable profits will be available against which unused tax losses can be utilized. What does that actually mean? And that sentence is very NB. So let's unpack what it means. Remember, IAS 12 is very clear about creating deferred tax assets. It basically states that you may only create a deferred tax asset if there is a probability that you will get the tax benefit of that DTA in the future. And the only way you're going to get a tax benefit from it in the future is if you make a profit, as simple as that, or if you make taxable income, as simple as that. So they told you here clearly that they do expect to make profits in the future. in which case it means we can raise the entire DTA on the assessed loss. The DTA relating to the assessed loss was correctly recorded for the year ended 30 June 2018. So what you've got to realize from that is in the trial balance, you can see that last year's deferred tax was a deferred tax liability. And there we go, 205,537. That's a DTL. So that DTL is after deducting the DTA on the assessed loss. When you do your tax calculation, it's always easier to work with the DTL separately from the deferred tax asset on an assessed loss. So you're going to separate it out into two components. It's just easier doing it that way. Okay, so that's a bit of a curved ball and is going to cause you a bit of a challenge when answering the question. The rest of point number 9, no other temporary differences exist other than those which are evident from the question. Okay, so let's just recap on the required. Calculate PBT, straightforward, doesn't need to be pretty, you're just going to climb in and do it. You don't need to think about it, just do it. Point number 2 is where you're going to spend most of your time. However, one of the things that you could do in point number 2, if you wanted to, is before doing point number 2, you could do the PP&E note, which is in part 3. And the reason for that is you'll probably save yourself a little bit of time, because obviously to do deferred tax, you need the PP&E information, etc. So if you wanted to, you could do the PP&E note of part 3 before actually doing part 2 of the question. I'm not going to do it in my answer. I'm just going to go straight into part 2 and do the calculations as I go along, but then I'll reap the benefit of those calculations when I get to part 3. Okay, so once you've processed all the information, you can then start with the required. The required of this question, as I said previously, was easily presented. So my suggestion is start with 1.1. There's absolutely no reason not to. And because it's a fairly straightforward calculation as well, it will give you a bit of confidence. So the next video is going to be looking at the answer to part 1 of the question.